It is Sam here, and today we have to address what is going on in the market. So every single day you're looking down at your portfolio and you're seeing that it's just red, red, red. You're losing money hand over fist. Some people are exiting the market altogether because they can't take what's happening. It's quite a fearful time at the moment, and a lot of stocks, especially ones that are high tech, high growth of the Nasdaq, are entered a bear market, and also cryptocurrencies were holding up quite well up until the last few days, and now they are crashing as well. So look, there's kind of a lot to talk about, a lot to kind of cover, just to try and work through what is going on and a few points that I've picked up on to try and understand what is happening, and will hopefully give some clarity to why we are seeing red day after red day, and hopefully we'll see a change in our fortunes at some point soon. But guys, just before we get into it, do hit the like button, hit the subscribe button. It does help us out an awful lot. And if you are interested, do check down for Caffe Pompeii Ireland, which is our new company that we've just launched, selling coffee beans, all that kind of stuff. So do check that out as well. And our other sponsor, 35mm Vintage, was also linked down below too. So guys, without further ado, let's get into this video on why the markets are crashing as hard as they are. So guys, the first thing that I wanted to talk on is actually something that is happening on everyone's day-to-day life. You may be sat there some days wondering, why is everything getting so expensive? So you might see things like petrol going up, housing going up, even the cost of groceries to a certain degree is going up. Everything, especially coffee. Coffee is the fastest appreciating asset of the last year or so, which is nearly up over 100%. So you're seeing coffee prices increase. So this is something that kind of needs to be covered, because a lot of people don't necessarily understand what inflation means to a degree and why it is happening so much in our day-to-day lives. So what has happened was, because of the pandemic, basically we all had to stay at home. A lot of people lost their jobs and weren't working. So these people all needed support. So what governments did, because they didn't have many other options, is they just printed more money and gave money to people to support them in the times of need until they can get back to work. So there's been a lot of money printed from the European Central Bank to the Bank of England and to the Federal Reserve. And I'm sure it's happened in a lot of other different countries as well, where they're trying to prop up their economy by just printing more money and handing it out. So this has provided an interesting situation where now there is too much money in circulation, where people have more money to spend on things. So it has brought forward demand for items, to say, for example, a phone, so Samsung. A lot of people have more money to spend because they're sat at home, can't spend it, can't go on holiday, nothing like that. So they're looking and they're buying devices. So they brought forward a lot of demand. People, they couldn't keep up with the production because of people being off and places being closed, and then the demand brought forward also resulted then that shipping needed to be used more. So you also then had a massive shipping backlog because of all of this demand that was created from the money printing that went on in 2020. So this needs to be kind of slowed down. So inflation is hitting rates of an average of 7%, 7 to nearly 10% in the US. And it goes around 5% in Ireland. And I think the UK has similar numbers to us as well. But this is probably not too true, because you're seeing things like petrol going up crazy, housing going up crazy, and even the stock market last year was up over 25% plus. So it's all been very, 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 very good from that perspective. If you're invested in assets, it's very, very good for you. But it's not good for people that are not invested in assets. They get left behind in these situations. So inflation is out of control to a degree. So what the governments generally do when inflation is high, they will increase interest rates from where they are right now, which is pretty much nothing, pretty much between 0.1% of interest rates, which is absolutely nothing. So the Federal Reserve, obviously we're going to be looking more at the Federal Reserve because a lot of the stocks that we buy is in the US. So they're looking to increase rates potentially to 0.25, which will be following what the Bank of England did just before Christmas in increasing rates. So this will make money less available, well, potentially more expensive to have. So a lot of these high growth companies are going to get hit with this because they don't have access to as much liquidity as they wanted to, as they did have. So they can't put as much money into like marketing and growth and all that kind of stuff. So this is a concern, is why a lot of growth stocks have been getting hit, as there's been talks of the interest rate increase. So that's one of the reasons. Also, inflation. Like, so this kind of goes in the same line as this. So inflation is making earnings and forecasts, what they think they're going to go to, is now going to be worth less than what it was previously. So if inflation keeps going at like 10%, your earnings are going to be worth 10% less. So that's also a context. So a lot of people are fleeing from these high growth stocks and they're moving into stocks that have earnings. So that's why people are getting off risk assets and moving into less risky assets as they kind of look to winter out the storm of inflation and interest rates going up. But it seems to be affecting all stocks. So most stocks in the NASDAQ have been nearly in a bear market for the last couple of months. Over 50% of them are nearly down 50% from their 52-week highs, which is pretty crazy. And now we're going to start seeing it actually happening in big tech. So they're going to start getting it. So Amazon hasn't moved. Amazon was 3,600 in 2020, summer 2020. Now it is under 3,000. So now they're going to start hitting the big tech as they are having a more and more hawkish or downtrodden expectation on what they think the economy is going to do for this year. You have people like Elon Musk coming out where he's expecting a recession to happen this year or very latest in 2023. So there's a good lot of things going on that is causing uncertainty. One thing that actually isn't causing uncertainty in the market is coronavirus. So people have nearly moved on from this. They're now actually looking at only economic problems rather than medical problems. Even though we're having sky-high cases, the new one seems to be a lot less effective against people. So that's not as much of a concern as inflation is, and the fear of having to increase rates dramatically. And also, so inflation is the main thing really, and people wanted to get away from risky assets and more into the stable ones. So you have a lot of kind of factors going on like this. You also have the bond yields in the US, which are also still going higher. So people are basically taking their guaranteed returns rather than putting into anything that's kind of risky at all, just to basically get a return. So you have the NASDAQ at the moment, which is only down 12% year to date in the first 3 weeks of trading. This is one of the worst Januaries of all time. So if you're looking at your portfolio, you're seeing it going down every single day. Every trading day it's open, you're seeing it going down. You're definitely getting sick of this. You don't like to be seeing this, but the thing is now it's actually creating a lot of opportunities for people to get into stocks that had sky-high valuations. So now you can start to pick up stocks. So my kind of strategy will be to invest through this. I'm young enough that it won't really affect me too much. I'm going to find companies that I think are going to be very, very good over the next 5 to 10 years, and I'm going to continue to invest in them. Just because it's going down for a month or two, it's not actually a massive deal for me. I kind of get obviously sick, and you get annoyed that you're losing money every single day. But it's creating more opportunities for you to get in the market and basically take advantage of some of the deals that are there. So like a couple of the stocks I recently purchased is Square and Unity Software. They're down massively at the moment, and I think Unity Software is a great play for the metaverse, and also Square for exposure to cryptocurrencies and the fintech. And then you've also going to go like Qualcomm and stuff as well. But it's creating a lot of opportunities that weren't there a couple of weeks ago. Things were way too expensive, and I find that when things are more expensive, there's actually more of a degree of fear. But now things are getting cheap, especially in the small to mid-cap stocks, that this is just kind of going to be easy money over the long term, because you're not buying things at sky-high valuations. So that's what you kind of need to consider. Are you going to be in this for a while, or are you going to sell out of the market just because things have gone down over a month or so, you need to ask yourself this question, like, okay, I've lost 10% in a month. Does this mean I am not going to invest anymore? Probably not, unless you can't handle it. Yeah, look, if you can't handle it, then you probably shouldn't be in the game of investing anyway in the first place. So, like, I'm concerned, and you kind of get annoyed and stuff, but over the long term, I'm not too concerned, as these corrections are normal phases of the market. It's just because a lot of people that would watch this are new to the market, so you haven't seen these corrections, and you think it always goes up in a straight line. And if you can't handle volatility, you shouldn't be in like high growth stocks or cryptocurrencies. They're high risk assets that move a lot. So you can have your Ethereum be at 4,000, and then within a month it'll be down at 2,000. And this should be not something that you'd be like, oh my God, I can't believe this happened. That should be something you should always expect that it will happen. And it's just when you're dealing with high risk assets, like, this is what it is. And especially at the moment when there's a de-risking flow to the markets at the moment, people are trying to get away from risk as they see that there's such uncertainties in the market. So, like, look, there's a couple of things here. Like, so the S&P is nearly in full correction territory, which means a 10% drop or more. So, like, on average throughout history, it's just a stat I picked up on. The S&P on average, it takes 135 days to get from a correction from its peak back to where it was, or 116 days just to get back to break even. And this is from data dating back to World War II. So, look, it's not a crazy amount of time, and if you invest on the way down and slowly on the way up as well, and just consistently keep investing, dollar cost averaging into your stocks or your index funds or whatever way you want to do it, you will come out on top eventually. The thing is that also when you're looking more at cryptocurrencies, they are extremely speculative, so you have to just brace for volatility. You have to you have to put up with it to a degree. There's no guarantee that these things are all going to become usable. So you just pick a few cryptocurrencies that you think are good or they have usability, and you kind of just have to go with them. But you have to accept that you will have volatility. It's not going to go up in a straight line. And yeah, just sit tight, and you'll pick your investments, and hopefully you pick the right ones, and you'll make a lot of money over the long term. So look, this is just a kind of a thing where I just needed to talk about what is going on at the moment, and the risks that are going on, and what is happening, and why people are de-risking. Look, people are just concerned. They're just concerned about inflation and interest rate hikes. There's a lot of uncertainty and a lot of de-risking at the moment. But I think, like, as we kind of get into March, April, a lot of these things will clear up. At the worst of coronavirus will be completely gone by then, I think. Hopefully, especially Ireland, one of the more conservative countries for coronavirus, has gotten rid of all its restrictions pretty much. So that's overwhelmingly positive. And I think we might have 1 or 2 months more of volatility in the stock market, and then we might just kind of get back to normal. But cryptocurrencies, like, that's just, I don't know. We don't know how that's going to go. We could enter a bear market for the foreseeable. We don't know. I feel more for the regular markets, we're closer to getting to a bottom and to start picking back up, rather than like we're going to be losing another 20-30%. I don't think that's going to happen. I do think we're closer to the bottom than we think, and things will start to turn and go on the uppick over the next while as well. So guys, look, I just wanted to touch on what was going on, and people are a bit concerned and don't really know what's going on at the moment. If there's why the markets are constantly going down. Every time you look at it, it is down. But look, I just wanted to talk about it and what some of the reasons that it is happening for. So guys, if you would like this, just remember, hit the like button, hit the subscribe button. Logan, I hope we all kind of get out of this slump in the next while as well. And look, I will see you in the next one. And do make sure you check out our websites down below for Caffe Pompeii and also 35mm Vintage too. So thanks guys, I'll see you in the next one.